The following script was written, verified, and approved by compliance professionals at financial regulation courses. Modern portfolio theory, universally abbreviated MPT and also called mean variance analysis, is the foundational mathematical framework of professional investment management. Introduced by economist Harry Markowitz in his landmark 1952 paper, it established that the risk of any security is its contribution to the overall risk of the portfolio. By combining assets whose returns are imperfectly correlated, investors can construct portfolios that achieve a given expected return at a lower level of total risk. Markowitz received the Nobel Memorial Prize in 1990, shared with Merton Miller and William Sharpe for this transformative impact on investment theory. Before MPT, practitioners selected securities primarily on their individual merits, without systematic analysis of how they affect the overall portfolio's risk profile. Markowitz's insight that portfolio risk is a function of the covariances among returns permanently changed how professionals think about diversification. MPT is the foundation for the efficient frontier, the capital asset pricing model, and the security market line, making it a core focus of the Series 65 exam. The central insight is that the risk of a portfolio, measured by standard deviation, is not simply the weighted average of its individual components. When two securities are combined, their joint risk is determined by their individual volatility and the correlation between their returns, the degree to which they move together. The portfolio variance formula makes this relationship explicit, accounting for weights, variances, and the crucial covariance between the two assets. When correlation is less than +1, the case for virtually all real assets, the portfolio standard deviation is less than the weighted average. Diversification works. If correlation is exactly -1, a portfolio can theoretically be constructed with zero variance. This mathematical relationship is the engine of MPT. Modern portfolio theory rests on two foundational assumptions about investor behavior that together define the framework's core quantitative logic. The first assumption is that investors are rational, meaning they make decisions by systematically evaluating expected return and risk without emotional bias. The second assumption is that investors are risk-averse, meaning that between two portfolios with the same return, they will always prefer the one with lower risk. Risk-averse investors accept risk only when adequately compensated through higher expected returns, explaining why equities must offer higher returns than bonds. Together, these assumptions generate the fundamental conclusion: every rational investor seeks the portfolio offering maximum return for a given level of risk. One of the most important contributions of MPT is the decomposition of total investment risk into systematic and unsystematic components. Systematic risk, also called market or non-diversifiable risk, arises from broad market forces, like interest rate changes and geopolitical events affecting all investments. Because systematic risks move all assets together, they cannot be reduced by combining assets. The portfolio remains fully exposed to these broad market forces. Unsystematic risk, or diversifiable risk, arises from factors specific to a company, such as a drug failure or a production disruption. Because these risks are independent, they can be substantially eliminated by holding a diversified portfolio of 20 to 30 securities from different industries. The correlation coefficient is the single most important variable determining how much risk reduction is achieved by combining any pair of assets. Domestic equities are highly correlated, while high-quality government bonds have historically shown low or negative correlations with equities during market stress. William Sharpe extended MPT in 1964 by introducing the risk-free asset, creating the capital market line connecting the risk-free rate to the market portfolio. MPT has limitations. It assumes normally distributed returns, which understates the frequency of fat-tail extreme events like the 2008 financial crisis. During market stress, correlations often spike, meaning diversification benefits are reduced, exactly when investors need protection most. Awareness of this is critical. In summary, MPT established that portfolio risk is determined by covariance. Systematic risk is measured by beta, while unsystematic risk is specific and diversifiable. Visit financialregulationcourses.com to access one of the industry's fastest-growing finance dictionaries. Learn how our technology helps you present yourself with greater credibility.